So what's going to happen is the dollar gold, call it exchange rate, the dollar price of gold. So the LBMA, the COMEX, the London Metals Exchange, JP Morgan unallocated forward contracts, the whole huge gold market in dollars is still going to exist. In fact, the BRICS want it to exist. And if I could just digress for 1 minute, I've never seen an international monetary economic problem that has created more confusion. I won't say misinformation, that's a little trite, but just confusion or maybe deliberate hyperbole than this one. Because let me tell you what this is not. I'm going to tell you what it is, but it's important to know what it's not. This is not the petro yuan. This is not the petro ruble. This is not a gold-backed yuan. This is not a gold standard. This is not the end of the US dollar. It's not the end of the euro. It's not the end of the world. It's not any of those things, but that's what everyone's running around on websites or whatever shouting about. It's none of those things. In fact, quite the opposite. And this is where the Russian mentality comes in. The BRICS want the dollar to be around. They want the dollar gold market to exist because they get the free ride. The dollar has to do all the dirty work in the gold space, and BRICS get the free ride. By declaring one BRIC equal to a weight of gold, again, weight's the key, they just let the dollar gold market go wherever it goes, and the BRIC is worth an ounce or whatever, kilo, whatever. And yeah, the dollar equivalent under the transitive law changes, but they're not pegged to the dollar. They're not fighting that fight. In other words, the BRICS get to free ride on the dollar gold system. And they want that system. They don't want it to go away because they get the benefit of a gold value. Now think of what the BRICS don't have to do in this scenario. They don't have to buy gold. They don't even have to own gold. They do, but no one in the world has enough gold to back a currency. This currency, the BRIC, will not be redeemable into gold. Now maybe there's a dealer somewhere who will take it. That's between you and the dealer. But it's not like you're going to be able to march down to the People's Bank of China with a pile of bricks and say, give me the gold. They're not going to do it. So it's not redeemable. They're not going to make a market. They're not going to maintain a value because they don't have to, because it's by weight. They just get to sit back and piggyback on the dollar gold system and let the dollar do all the dirty work with one twist. And here's the Russian contribution. So you don't have to close your capital account. You can close it, open it, whatever. You don't have to buy gold. You don't have to make a market. You don't even need that much gold. You just say, this is the ultimate fiat currency. The word fiat in Latin means I say so. Well, they say so, and there it is. Basically, this is a bet. This is a bet that the dollar is going to collapse against gold over time. I think that's a very good bet. This is not a 3-month forecast. I'm not saying gold's going to go up or down the next week. Who knows? But over time, now we're into what? Debt to GDP ratios, annual deficits, dare I say, modern monetary theory. I mean, all these ideas are ruining the dollar, and everyone can see it, but not yet. And so if you want to launch this new currency and you say, hey, long term, the dollar is going to collapse in terms of gold, I'll hook my horse to this wagon called gold by weight, and I'll just reap the benefits. And I don't have to do a thing. And so that you're defining it by weight. So the dollar gold market goes where it goes, but you don't really have to worry about it because you're anchored to weight. But here's the twist. And this is how it's going to play out. Now you're the United States. So you're like, looks like I've been painted into a corner. What can I do? Well, one of the things you could do, I've told the Treasury this for years, they don't listen. I mean, they invite me in, but they don't listen. One of the things you could do is buy gold. But what happens when the United States buys gold? The dollar price of gold goes up, and the BRIC gets stronger, and the dollar gets weaker. Checkmate. In other words, the U.S. is now in a box where you can't even get out of it by buying gold, because you're going to weaken your own currency relative to gold in the process, and the BRICS are just going to sit there and not lift a finger. So it's genius. I got to credit the Russians. I'm not saying the Chinese couldn't think of something like this, but this has got Russia's fingerprints all over it. Okay, people have been talking about this for 20 years. You know, the Great Reset, the end of the dollar, the collapse of the dollar, gold to the moon, et cetera. And it's never played out. And the reason are some of the ones, which is the dollar has these huge embedded advantages in the form of its reserve currency status, not because everyone loves the dollar or they even love the United States, but because we have the only bond market big enough to absorb global savings. The U.S. Treasury market is huge. It is liquid, but it's got a whole infrastructure. Primary dealers that bid at auction, when issue trading, settlement, clearance, futures hedging, options hedging, depository trust corporation, settlement, on and on and on. It's got this huge infrastructure of laws, rules, and regulations that they've been building for a long time. I would say 37 years since Alexander Hamilton. But above all, it has the rule of law that people just trust it. Don't have to like the dollar, don't have to like the United States, but you trust the market. The U.S., in response to the war in Ukraine, broke the trust. They froze the U.S. Treasury assets of the Central Bank of Russia. Unprecedented. And I'm a sanctions expert. I work for the intelligence community. It was part of what I did was, look at sanctions and CFIUS and a lot else. And as far as I'm concerned, I know that our BRICS friends agree, that's a default. Maybe S&P would call it a selective default, but Russia made the money. They bought the treasuries. They're entitled to principal and interest. And we're saying, no, you can't have the principal and interest. We're not paying you. Well, that's a default. I don't care how Janet Yellen wants to dress it up. And it was a shock. But worse than that, everyone else in the world was watching. Saudi Arabia, India, Brazil, Malaysia, and they're saying, and Turkey and others, and they're saying to themselves, what if the United States doesn't like what I did? What if they don't like my policy? Are they going to freeze my treasuries? Well, until a year ago, you would say, well, of course not. They would never do that. Well, they did in the case of Russia, and they will potentially in the case of these other countries. So that was the catalyst. The idea of getting out from under the dollar, yeah, it's been around a long time. The feasibility of that was limited, capped really by the absence of a bond market big enough to absorb global savings. But now the countries are saying, well, what good is it to have my savings in treasuries if you're just going to steal them? So I'm not saying BRICS are wonderful out of the gate, but at least it's not dollars. At least it's not maintained on a digital ledger at the U.S. Treasury, and at least you can't steal it. And so that was the catalyst that drove this thing from a 17-year project to, hey, warp speed, let's get it done. How do we do it? And there we are. In 2020, they were back to where they started in 2013, except worse, because the balance sheet was even bigger. It's not going to take 7 years this time. It might be more like 7 months. And the reason is twofold. Number one, we're more leveraged and the stock market is more bubbly. And so the whole thing's more vulnerable. Number two, the market has seen this movie before. Like, hey, we watched this play out. We know it doesn't work. And the Fed balks. Now, so if the Fed suddenly slams on the brakes, says we're not going to keep raising rates along the lines I projected earlier, okay, that might give the stock market a boost. And you can't assume that won't happen. You got to watch for that. But I would expect that things would have to get pretty ugly in all events before the Fed got that message. On the other hand, if Powell gets confirmed and feels like it's his last term and here's his chance to be Paul Volcker and he's just going to keep raising rates, he said, my job is to get inflation under control. The rest of you people, you're responsible for fiscal policy and tax policy and spending and shutting down the Keystone Pipeline,
welfare,
and all that. That's on you, not me. My job is to get rid of inflation. If he does that, and he might, you're looking at a recession, kind of looks like the global financial crisis, and hope it doesn't. And there's a difference between extreme recession and financial crisis. They're two different things, but they can happen at the same time as did happen in 2008.
In this video, Jim Rickards talks about the challenges and potential risks faced by the Federal Reserve in managing the economy. The central theme revolves around the delicate balance that the Fed must strike between preventing a stock market crash and avoiding a severe recession. Jim raises concerns about the Fed's ability to have perfect information, citing flawed models and the possibility of being behind the curve in recognizing economic challenges. The distinction between a recession and a financial crisis is highlighted, with historical examples used to illustrate that these two phenomena can occur independently. Jim Rickards emphasizes the difficulty the Fed might face in choosing between preventing a financial crisis or accepting a recession as a trade-off. The reference to Paul Volcker's actions in the 1980s adds historical context, showcasing a deliberate choice to induce a severe recession for the purpose of combating inflation. However, Jim Rickards notes that the current economic landscape is more intricate, with additional considerations such as systemic risks and the potential for a recession triggering a financial crisis. In conclusion, Jim Rickards underscores the complex decisions the Federal Reserve must make, acknowledging the uncertainties and trade-offs inherent in steering the economy and avoiding undesirable outcomes. Before we get into the video, can you help me to give that like button a little touch? All right, let's get into it.
Would the Fed back off if it became apparent that they were going to cause a stock market crash, a disorderly collapse, and a severe recession? The answer is almost certainly yes. But the problem is it might happen anyway. In other words, they might have gone too far. And this almost happened in 2018, and that was my point. It was that by the time they realized their mistake, it might already be too late. So that's one danger, which if they had perfect information, oh, gee, we went too far, gee, we couldn't pull this off, we need to back off. They might back off exactly as you described, but they don't have perfect information. They have flawed models. They tend not to look at history, and they could
behind the curve.
They could crash the car before they knew it was out of control. It's like slamming on the brakes on ice. You can slam on the brakes, but you're going to go for a long time before the car stops. So that's one problem. The second problem is you have to separate, as I said, recession, even severe recessions, from financial crises. In 1998, we had a financial crisis, but no recession. In 1994, we had a financial crisis, no recession. In 2020, we had a severe recession, no financial crisis. That was not a financial crisis. In 2001, we had the NASDAQ collapsed 80%, but there was only a very mild recession, and that was not a financial crisis. So the Fed might say, and again, might, because who knows, but they might say, well, of course we don't want a financial crisis. Now, to your point, Nick, nobody wants that, and they do get out of control. But we're not worried about that. You know, we learned our lesson in 2008. We had Dodd-Frank. And I had this discussion with James Gorman, the CEO of Morgan Stanley. I briefed their board, and they gave me a lot of pushback. They said, "Oh, you don't understand, Jim. We have more capital and greater liquidity and less leverage and better credit." And I granted that. I said, "You're absolutely right. I said, nice job. You're a stronger bank now than you were then." But in a financial crisis, it doesn't matter. The problem is systemic. In other words, as an individual bank, you may be better off. But if the whole system's collapsing, you can't necessarily withstand that. So they don't want that. But what if they said to themselves, you know what, we don't want a financial crisis, but we don't think that's going to happen. But maybe we'll just have to bear a recession. Volcker knew what he was doing. Volcker knew that there was going to be a recession. And the recession of 1981-82 that he caused was at the time the worst since the Great Depression. Now, we've surpassed that twice since then, 2008 and 2020, although it's hard to know what 2020 was. I mean, down 36% in 2 months and up 38% the next 2 months. I mean, what is that? But at least in technical terms, we've had two worse recessions, 2008 and 2020 since then. But at the time, and I lived through that, I was around, that was the worst recession. But Volcker knew that would happen. He said, that's the price we have to pay to break the back of inflation. And he did. And by 1986, inflation was like 2% or 1.8%. Now, there was far less worry about financial crises at the time. Because remember, this was before the repeal of Glass-Steagall. You know, commercial banks, no one really cared about investment banks. They could fail. So what? They cared about the commercial banks, and they had a pretty good handle on that. So they weren't worried about financial crisis. But today you would be for the reasons we mentioned. So there are two possible major blunders here, but again, don't underestimate the Fed's ability to do both. One is that they could decide they don't want a recession, but not know until it was too late. They just tighten into it, don't know it until it's too late, and then the damage is done. The other one is they could sign up for a recession, say, yeah, sorry, but that's the price of getting inflation under control, and trigger a financial crisis that nobody wants but could happen anyway. So, it's kind of so and Charybdis, take your pick. Severe recession, but we know it's coming. Recession that causes a financial crisis that we didn't want, or just let the inflation rip. What's the good outcome there? What's the good one?
Yeah.
But I think those are the three choices. I think you're right.
In the face of these complexities, our discussion leaves us with three potential scenarios: the risk of unwittingly tightening into a recession, the prospect of accepting a recession for inflation control, or the challenging choice of allowing inflation to run rampant. The Federal Reserve stands at a crossroads, and the decisions they make in the coming months may well shape the economic landscape for years to come. As we conclude our exploration, it becomes clear that the path ahead is fraught with challenges and decision-making. The balancing act between preventing a stock market crash and avoiding an unintentional recession places the Federal Reserve in a formidable position. The lessons from 2018 serve as a stark reminder that perfect information eludes them, and the consequences of their decisions may only become apparent once it's too late to correct. The historical perspective sheds light on the dual nature of economic downturns, where financial crises and recessions don't always go hand in hand. Drawing parallels to Paul Volcker's bold strategy in the 1980s, we ponder whether the Fed might consider accepting a recession as a necessary sacrifice for taming inflation.
China doesn't have any of that. None of it. There's no significant Chinese bond market. They don't have the infrastructure of banks and dealers I described. They don't have the physical infrastructure. And most of all, they don't have a rule of law. You can't trust the Chinese as far as you can throw them. I was a facilitator and then a participant in the first ever financial war game ever conducted by the Pentagon. We did this at a top secret location called the Warfare Analysis Laboratory. One of the things we did there, I was on the China team. I wanted to make it realistic. So I said, let's lie, cheat, and steal, because that's what Wall Street does. And that's a more realistic game. So I recruited a friend of mine who's fluent in Russian to be on the Russian team. And I had dinner with him before we went down to the laboratory. And I said, look, here's the plan. I'm going to persuade my China team colleagues to basically announce a new gold standard. And we've accumulated enough gold, and we're going to say, for now on, our currency is backed by gold. We're going to put the gold in Switzerland to keep everybody happy. We're going to issue notes from a bank created in London under English laws to keep everybody happy. Here's the thing. We're going to say, from now on, if you want our exports, you have to pay for us in this new currency. We're not taking dollars anymore. And furthermore, and if you want some of this new currency, you can deposit your gold in Switzerland and the bank will issue you some currency, so you're in the system. Or you can trade with us and run a surplus, and then we'll pay you in the currency and you can use that to buy our stuff. Or we'll give you loans. But one way or another, we're done with the dollar. And obviously this is very forward-leaning, but the whole idea of a war game is to help the Pentagon think 5 or 10 years ahead. So the first thing that happened when you go to your embassy, your conclave, you come out and you stand up at the podium, you announce your plans, and then everybody reacts and it's discussed, et cetera. The first thing that happened is there was a group. So you have the red team, the yellow team, the blue team, as the case may be, and they're all different countries or areas. But there's a white team, which are the referees. They decide what you did. And the first thing they did when we announced the gold move, they ruled it as an illegal move. They said, no, that's not in any of our scenarios. You can't do that. And I stood up, and about 100 people in the room. There were 3-star generals, CIA, FBI. I said, wait a minute. I said, this is a war. There are no illegal moves in a war. The whole idea is to be out of the box or live in a world where there are no boxes. That's what we're doing here. So they agreed. They said, okay, we think it's a really dumb idea, but we'll let you do it. Well, over the course of 2 days, it accelerated and gathered momentum. At the end of it, Russia got PowerPoints. Okay, so this was 2009. Within 10 years, so what facts happened? Within 10 years, Russia tripled its gold reserves. Last week, the dollar value of Russia's gold exceeded the dollar value of its treasury securities. They have 20% of their reserves in gold, and the value of their gold is more than the value of the U.S. treasury securities. They're dumping treasuries, buying gold. Exactly what we warned the Pentagon about 10 years ago. And here it is, and China has more than tripled its reserves. So we're not there yet, but we're moving to some kind of gold-backed world. But the point is, that was all in the war game. That's all in the book. And I made one other point. I said, currency wars don't happen all the time. They might only happen twice in a century. But when they happen, they can last for 10 or 15 years. That's how long it takes to sort out. What you describe about the Chinese money supply is absolutely correct. People in the United States complain, the Federal Reserve has printed $4 trillion in the past year. And they have printed $4 trillion in the last year. They're taking the Fed balance sheet from about 3.5 trillion to 7.5 trillion. So yeah, we printed $4 trillion in the past year. Didn't do any good, won't do any good, but we did it. But Chinese money supply is even larger and growing faster. Now, I don't want to get into the weeds on China's internal monetary policy. I could, except to say that they're grossly over-leveraged. the economy is investment driven, not consumption driven. They're about 40%, 45% investment. The US is about 25% investment. So that gives you some idea of how investment is to the Chinese, which is actually okay if you're investing in productive assets that pay their way. They're not. They're wasting the money. I've been to China many times, been going back and forth there for 35 years. I've been out in the countryside. I don't just stick to the hotel lobby in Beijing. I got mud on my boots visiting these ghost cities. And so each ghost city, there are a bunch of them, actually seven. Imagine building 7 cities. That's what I saw. And so they got 1 or 2 skyscrapers, and they got mixed use, and they got retail shopping, a country club, a hotel, a golf course, a pond, highway stops, airport, etc. And it's all empty. I mean, it's just all empty. Shiny new construction, some of it's still under construction, all empty. So I said to the communists, I said, what are you guys doing here? I mean, nobody's here. So, oh, don't worry. People will be coming from the countryside, and they will be populating these cities. And I said, when? I said, no one's coming. And besides that, you've already drained the countryside. That already happened. But I said, you cannot mothball a building. It's not like some old clothes. I mean, the way a building maintains itself, it gets occupied and there's maintenance and people fix it and all that. I visited, I used to travel a lot in Central Africa in the early 80s. Zaire at the time, today it's the Congo. I was in Kinshasa, but it was right after the 70s commodities boom. And they took the money, of course they wasted it, and they built these skyscrapers in Kinshasa, which is like a swampy, scary, funky, city. But there's a skyscraper, but the windows are falling out, and there were rust stains running down the side, and the elevators were broken. So it might have looked nice the day they built it, but it was never really used. And now it was literally, when I was there, it wasn't that much later after they built it, it was falling apart. So that's going to happen in China. My point being, if you apply, generally accepted accounting principles to their investment account, you would write it off the day they open the building because nobody's there. It's not worth anything. So they're wasting the money. They're over leveraged. They're overprinted. However, none of that has anything to do with the status of the Chinese yuan as a global reserve currency. The yuan is not a reserve currency. It will not be, probably in my lifetime, maybe never. And I'll tell you why. Because a lot of people don't understand what a reserve currency really is. You get a report from the IMF, and it says, 60% of global reserves are in dollars, which is true, and about 25% are in euros, which is true. So 85% of global reserves are in dollars or euro, which means the only meaningful exchange rate in the world is the euro-US dollar cross rate. Everything else is working around the edges. You got some sterling and yen and Swiss francs and a couple other things. Aussie dollar is tiny, believe it or not, good currency, but not a big part of it. And China's like this kind of invisible 1% sliced down at the bottom. And China has $1.4 trillion in its reserves. But here's the point. It's not as if they have pallets of $100 bills stacked up in the basement of the People's Bank of China. They don't. You invest in securities. In other words, they're dollar-denominated securities. So it's not actually dollars. They're treasury bills, notes, and bonds denominated in dollars. So the thing that makes a reserve currency is not the currency, it's the bond market. You need something to invest in. Again, so you need a liquid bond market with different maturities, different interest rates. You need dealers, you need auctions, you need payment and clearance systems, you need repo or repurchase agreements, futures, options, when issued trading, custodians, the rule of law. There's a whole massive infrastructure, which we started working on when Alexander Hamilton was, advising George Washington, and we've been doing it ever since. And others, Bank of England has done the same. China doesn't have any of that. None of it. There's no significant Chinese bond market. They don't have the infrastructure of banks and dealers I described. They don't have the physical infrastructure. And most of all, they don't have a rule of law. You can't trust the Chinese as far as you can throw them. And so they have no chance of being a global reserve currency, none. Same with the Russian ruble, same with a lot of other currencies, same with Bitcoin. Show me the Bitcoin bond market. Maybe you can get my attention, but not sooner. So none of those are going to replace the dollar. First thing, my wife hates me to admit this, but I was once a registered lobbyist in Washington. I ran an office there. I spent a lot of time on Capitol Hill. And the first thing I learned in Washington is you can't beat something with nothing. In other words, if you hate a policy or a program, you just hate it, you write op-eds, fine. You're not going to change it unless you bring something to replace it. So for all the criticisms of the dollar, and there are plenty of them, you're not going to dethrone the dollar as the leading global reserve currency unless you can show me what you're going to replace it with. And there's one and only one contender in the world today, which is gold. So that's a whole other conversation. I'm not saying we're going to be on a gold standard tomorrow. As far as China's concerned, yeah, China's a house of cards. It's going to collapse. It's going to be ugly. Hard to say when, but probably sooner than later. And they know it. And they're not going to be a global reserve currency. So we can put China to one side, but yeah, China's a house of cards. Now, getting it back to the United States, the first point, let's talk about stimulus first. So yeah, the Fed printed $4 trillion. Congress, we had $1 trillion, what are called baseline budget deficits going into the pandemic. So with no pandemic, we were going to have $1 trillion deficit in 2020 and 2021. Now, Congress put $3 trillion on top of that with rescue and bailout programs last March, April, and May. That was the CARES program, payroll protection plan, aid to hospitals, extended unemployment benefits, higher unemployment benefits, et cetera. I'm not saying any of those things were bad. It was needed to keep things from getting a lot worse. But we put $3 trillion on top of this. So there's $4 trillion for fiscal 2020. They just did $1 trillion last week in the kind of final days of the Trump administration. So that's $5 trillion. And Biden has announced his plan. He's going to have a $2 trillion rescue bailout, so-called stimulus plan now. So that's $7 trillion plus the $1 trillion baseline for fiscal 2021. So there's $8 trillion in deficit spending in 2 fiscal years, $4 trillion of money printing by the Fed. Now, those are the numbers. That's not projections. That's baked in the pie. Just don't call it stimulus. It will have no stimulative effect. Does it, again, as I say, keep the lights on? Yes. Would some people keep their jobs last spring because their employer got payroll protection plans? Yes. Did other people benefit from increased unemployment benefits? Yes. Was a lot of that necessary because things were in such bad shape? Yes. So I'm not arguing that side of it, but it does not stimulate. It's not going to get us out of the depression. Let me be very specific as to why, because I don't make claims without backing it up. On the money supply, you can print all the money you want, but Milton Friedman was wrong. The monetarists are wrong. The Austrian school is wrong. Money printing does not cause inflation. What causes inflation is something called velocity, which is the turnover of money. The money has to be lent and spent. Banks have to be lenders. People and businesses have to be borrowers. You have to be spending it, get it in circulation, in other words, in order potentially to have some inflation. And that's the technical name for that is velocity. Velocity is dropping, sinking like a stone. And by the way, it's been dropping since 1998. It dropped faster in the 2008 crisis. It's dropping faster today, but the trend has been very steeply down for the last 22 years. And so, nominal GDP, so the dollar value of all goods and services, leaving aside inflation, that's what we mean by nominal value. Nominal value of gross domestic product is money supply times velocity. How much money is there and how much does it turn over? Multiply one by the other, and that's your nominal GDP. And I remind people that $7 trillion times zero is zero. Meaning you can print the $7 trillion, but if you don't have any velocity, you don't have an economy. And so you can understand monetary policy is a desperate race between increasing money supply and declining velocity. One offsets the other so that you barely keep nominal GDP where it is. In fact, it's going to go down about 6 or 7%. We're not getting back to 2019 levels of output. If you take 2019 as your baseline, we're not getting back to 2019 levels till 2023. At the earliest. We're not getting back to 2019 levels of job creation, the number of people who have jobs until 2025 at the earliest. That's why I call it a depression, not a recession. Now flip over to fiscal policies like, hey, they're sending everybody $2,000 checks. And they are. The people are going to get those checks. And so the Wall Street, which usually gets things wrong. That's the first thing you got to know about Wall Street, because they don't really care about you. They care about rap fees and how they make money. So they're saying, all right, they're going to send out the $2,000 checks and people are going to get those checks and they're going to run right out. And they're going to buy a car, a refrigerator, paint the kitchen, whatever it may be. No, the first two things are true. They're going to spend the money and they're going to borrow the money and they're going to send people the checks. But when people get the checks, they're not spending it. What they're doing, they're saving it. They're either paying down debt, which is equivalent to savings, or they're putting the money in the bank, which is savings. So certainly if you lost your job You're not going to take your friends out to dinner. You're going to throw the money in the bank or pay the rent. But even if you didn't lose your job, you look around, like maybe your spouse lost his job. Maybe your neighbor lost his job. Maybe you think you're next, like you have a job, but you're worried you're going to get fired next week. So you save it. And the name for that, economists call that precautionary savings, or, plain English, it's saving for a rainy day, except it's raining everywhere. So they are going to send the checks out, but people aren't going to spend it. And that's the reason you're not going to get the stimulative effect. But you are going to increase the deficit, which gets back to this debt to GDP ratio. So take the total debt divided by GDP, and that's some ratio. The research is very convincing, very clear. Just to kind of cut to the chase, the banking crisis is not over. The crises don't happen all at once in one day. They emerge, regulators deal with them, the other new investors come in, they go, it's all good, we got this under control, and then there's a quiet period, and then they just pop back up again. It's because they were never fixed in the first place. Let me explain why the banking crisis is not over. And for here, we're going to use a little financial history, which is underrated, but in my view, extremely valuable. Maybe just because I've been around long enough. I'm kind of a magnet for trouble when it comes to this. My first banking crisis was the Herstatt Bank in Germany in 1974. You have to have been around a while to remember that one. That was a foreign exchange. That was a bank where, in those days, if you were in Germany and the US and you were doing foreign exchange trading and you sold, it was Deutschmarks because it was before the euro, if you sold for dollars, you would, or bought them rather, they would deliver the Deutschmarks to you in German time, and then you would pay the dollars in New York time. They failed in between. They got all the Deutschmarks, but they never paid the dollars because they failed in the middle of the day, and that started a crisis. But anyway, it's a long list. But let me point to two in particular. So the first one I had some front row seat, 1997, 1998, the Asia-Russia LTCM financial crisis. Now, what people don't realize, people remember September 1998, LTCM's about to go under $1.3 trillion in derivatives. That's back when a trillion was real money. The Fed had no interest in bailing out a hedge fund. I was there. I was their lawyer. We didn't expect to bail out. We're like, why would the Fed bail out us? Why would the Fed do that? Well, the answer was, it wasn't about us. It was about the 19 banks that were going to fail if we fail, because they're dealers. So if they sell us, $1.3 trillion of derivatives, which they did, they buy them from the other side. And they're relying on the fact that they have a two-sided position and they make a spread. That's what they do. If one side of the trade goes away, all of a sudden they're net short, they're naked on the other side, and they got to go out and sell stocks, like $15 billion worth of stocks, to cover the fact that they were long that much on their side of the swap. Well, I can tell you what $15 billion of fire sales stocks will do to the stock market. They would have closed the New York Stock Exchange and a lot else beside. So technically, they were bailing us out. We got $4 billion in cash. I'll put the fire out. But they were really bailing out Wall Street. We lost the money. Wall Street put in the $4 billion, but then Wall Street owned it. And they got all their money back a year later, but they put out the fire. But here's my point. That didn't start in September 1998. That started in June 1997 in Thailand. Thailand had a run on the bank. Dollars were leaving the country. They had pegged the Thai baht to the dollar, and people panicked. They said, because money had been going in for resorts and casinos and what else. And everybody wanted their money back, taking the dollars out. The Central Bank of Thailand could not maintain the peg. They imposed capital controls, said no more dollars, and we're going to devalue the baht, which meant for a U.S. investor, all your money was worth a lot less. That then pretty quickly spread through Asia, and then it went to Korea. But here's the point. It entered a quiet period. In December, January, February, things calmed down, and everyone said, it's okay. And by the long-term capital was fine. At the time, we were like looking into Asia for investment opportunities. But then it came back in April in a small way, because Sandy Weil was he was merging Citi and Travel. And he told the Solomon guys, I don't want any volatility in earnings because I don't want to mess up this deal. So you guys have to reduce your books. But the process of Solomon getting out of swaps widened the spreads. We're sitting there long-term like, hey, spreads are blowing out, buy more. And then, of course, it came to a head in August. Russia defaulted on their internal debt, their external debt, and devalued the ruble. It was like a trifecta. And then that caused a panic, and then it got worse. And then finally the bailout at the end of September. But my point, and right now, and this is what Powell's been saying, The Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 50 basis points on February 1st, and then probably 25 basis points in March. March 22nd is the Fed meeting after that. So those 75 plus the 450 we have now, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So, so Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid 2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think, and rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question is, that's the lay of the land. There's the two competing sides. How does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. If you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. Because you have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war, when they cut us off from oil, and you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing, and that's still the case today. So of course prices went up, and people were trying to pay whatever they had to get what they needed, and energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today, because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices, because people can't afford it. Maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons. The debt's not going up at 2% or 3%. The debt's going up 8, 9, 10% or more. The U.S. had a $1 trillion baseline budget deficit, $1 trillion per year deficit for fiscal 2020 pre-pandemic. The Congress threw $3 trillion of emergency aid on top of that. And I'm not even criticizing all those programs. I mean, the payroll protection plan loans, the extended unemployment benefits, the increased unemployment benefits. Imagine where we'd be if we hadn't done that. But that aside, debt is debt. They piled $3 trillion on top. Now, this is going to take the U.S. debt to GDP ratio up to 135%. It was 106% when Donald Trump was sworn in. It's close to 130% today. Because remember, you got two things going on. It's a debt to GDP. So debt's your numerator and GDP is your denominator, right? Well, what happened? Well, the denominator shrank. This got smaller and this got bigger. So what happens to the ratio? It blows up. So now it's 135%. If you get the laws of economics right, which is not easy because most economists don't, but if you get them right, it's really a reflection of human nature. I mean, what is an economy other than all the people in the economy starting businesses, buying, selling, traveling, providing goods and services, et cetera. So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change, and that's important. Now, to answer your question, Kerry, you're right. There is a school of thought, a growing one, an influential one, that the debt doesn't matter. It's like, well, wait a second. So what? So the debt to GDP ratio went to 135%, which it did. Who cares? Well, what's wrong with it? 180%. We got issues. We got problems. Print up the money and monetize the debt and spend it and keep going. What is the problem? This comes under the banner of something called modern monetary theory, MMT. It's flawed, it's wrong, but it's got its followers, and those followers are now in the White House because one of the things Joe Biden had to do to get elected was to make peace with the Bernie Sanders wing of the Democratic Party. They take the view that if the Treasury didn't spend the money, how would anybody make any money? That's ridiculous, but that's what they say. They say, hey, when the Treasury spends money, what do? Well, they build aircraft. They have benefit programs. They have government contracts. They do whatever they do. But when the Treasury gives you the money, you take the money and you spend it on somebody else, goods and services, go out to dinner, have subcontractors, whatever it might be. That's the real source of money. They also take the Treasury and the Fed and they merge them. Now, that's not legally the case. The Treasury and the Fed are separate institutions. The Treasury is just part of the executive branch, and the Fed is an independent agency. And the Federal Reserve banks are actually privately owned. A lot of people know, some people know that, some people don't, but the Federal Reserve banks are privately owned by banks in the districts, so Citibank, Bank of America, et cetera. So they're completely separate, but the theorists ignore that and say, no, the Treasury needs to spend money because that's how the economy grows, and the Fed can monetize the debt. So you spend the money you don't have, you borrow to cover it, you issue bonds to cover the borrowing. And if the market wants to buy the bonds, fine. But if not, the Fed can buy them and put them away on the balance sheet, wait 30 years and collect the money. What's the problem? Who cares about the debt to GDP ratio? It's kind of a statistical abstract, but why should that stand in the way of using money to solve our problems, which are free healthcare, free childcare, free tuition, forgiveness of student loans. That's a $1.6 trillion ticket, by the way. And look, everyday readers and investors, there's no reason they should know all this stuff. This is total inside baseball. You have to be a geek like me to kind of keep up with it, but it's all coming. But what that means is we're going to test the Rogoff-Reinhardt thesis. Now, let me just take a minute to explain that. Up to a certain debt to GDP ratio, there is a Keynesian multiplier greater than 1. So the classic example is the UK was in a depression before the rest of the world. They had been hit pretty hard before the Wall Street crash. People aren't spending, they're saving. It's the liquidity trap. So if you get money, you pay down debt. When you don't have any debt, you put it in the bank. Whatever you do, you don't spend it. You hoard cash. Or people were buying gold. They were accused of hoarding gold, et cetera. But what they weren't doing was spending. And there was a lack of aggregate demand, and the banks were not lending. So Keynes said, well, if everyday people won't do it, the government must. The government can borrow. The government can spend. And what they discovered was that if you borrow $1 and spend $1, you can get $1.50 of GDP. Now, there's a separate debate as to whether that's actually incremental or whether you're just pulling growth forward. But so what? Even if you are pulling growth forward, maybe that's what you need to do when you're in a liquidity trap. But there's a problem. He called it the general theory of employment, interest, and money. But it was actually a special theory. I think he had a little Einstein in me because of the general theory of relativity, but it's actually a special theory, which means it's a theory that works in a set of circumstances, a set of conditions. The conditions where it works are you're either in a recession or just coming out of one. You have excess capacity in labor and industrial capacity, and you have very little debt. In those circumstances, you can borrow $1, spend $1, and get more than $1 GDP. The problem is that extra GDP you get for the borrow and spend, it goes down as the debt to GDP ratio goes up. What Reinhardt and Rogoff discovered is that at 90%, you go through the looking glass. Your payoff is now less than $1. You borrow $1, you spend $1, and you only get 90 cents of GDP or 95 cents, et cetera. So now, not only are you not getting your dollar's worth for the borrowed dollar or something more, which you did at lower levels, you're getting less than $1. So now what's happening? You're borrowing $1, you're spending $1, you're not getting $1 of GDP, but you are getting $1 of debt, which means your debt to GDP ratio is going up and the 90% is getting worse. And I just mentioned the United States is at 135%. So here are your two competing schools. There's the Keynesian multiplier and creating aggregate demand with government debt, and the Reinhardt-Rogoff, more than a thesis, I would say powerful evidence that beyond 90%, it doesn't work. It goes under less than one on the one hand. And my friend Stephanie Kelton and Bernie Sanders and Kamala Harris and the modern monetary theorists who say, no, it's all good. How could you get growth if you didn't spend money through the government? These theories don't agree at all. We're going to find out which ones work. I'll give away the answer, which is that Reinhardt and Rogoff have it right. Keynes had it right up to a point. Reinhardt and Rogoff discovered that critical threshold, that whether you want to call it tipping point or phase transition, or which physicists call it or whatever. The modern monetary theorists think the opposite, and we're going to find out. But what it means if Reinhardt and Rogoff are right, and I'm right, and Keynes was right, the more you borrow, it's actually a headwind to growth. Now you get just as up to the threshold, you got more and more and more. Oh, sorry, at a low level, you got more, but then it went down. But it's like any diminishing marginal return. You know, the curve starts very steeply, you get a lot of payoff, then it flattens out, then it goes down, but it's still positive. But at some point, it goes below the zero line and your marginal return is negative. And that's where we are. The U.S. is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%. And it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. When wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just, not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you had a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low. Like they spent the savings they had. They didn't make new savings, and then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while, but then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25, 20 to 25%. So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards, and they're just backing away. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another. That sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation is not bad, and it'll give you a lot of optionality. You can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I would look at energy, defense, not for good reasons. There's enough wars going on, but defense will do well, and mining because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up. I get it. But it looks like they peaked and have turned around. So Treasury notes, a good 2-year note, a 5-year note, will perform very well, and they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. The interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but between 5.25% and 5.5% for a 6-month Treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good, but if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is If you think the 2-year note is going to go to 6%, you might not like it because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. And what it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points or whatever. And I said bond prices go up, which they do, but how much do they go up? Well, the answer is the longer the maturity, the more they go up. They're more volatile. And so the 2-year note's a really attractive piece of paper, very safe. You get your money back, liquid, you can get out of it, etc. The only reason not to buy would be if you thought rates are going to go up. I don't. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risks, stocks are coming down, then interest rates are going to come down too.
Yeah, I'm primarily a macro analyst. I look at technicals and fundamentals, but I really kind of bring the geopolitical and international and economic perspective to bear. So that's kind of what I do. But this is a very unusual situation where you sort of get a macro view of something and you realize, well, wait, there's a bigger macro view and then an even bigger one behind that. So you have to kind of keep going through the layers. So, of course, enormous amount of attention focused right now on the war between Israel and Hamas. But I still, I follow the Ukrainian war closely. I read a lot of history. We kind of know what happened on October 7th. The details, I don't want to dwell on it, but they're of the highest order of horror. What we don't know is, does this thing escalate? And this is where, for investors, I think the impact on oil prices is so important. So when the wars started, everyone said, oil's gone to 100 or 150 or whatever. It hasn't, and there was no particular reason to think that it would. What did happen is oil prices, they went up a little bit. I think like $85, maybe $88 a barrel, but they kind of stabilized. But now, put this in the global economic context, particularly the United States, gasoline consumption is dropping in the United States. The consumers sort of tapped out. They were spending their savings and using up their credit cards. Well, there are limits to that. Your savings get to zero and your credit card is tapped out and you can only make the minimum payment. And 20% interest, your principal is going to double in 3 years. So that's not going anywhere. It kind of looks like the consumers slammed on the brakes maybe around the middle of August, certainly in September. Gasoline consumption is down. That's usually pretty inelastic demand. You still got to get to work and take kids to school and all that. But gasoline consumption is down, which is a really negative economic sign. So a lot of other things are deflating. So with that as background, one would expect that the wholesale price of oil, WTI and Brent would come down, but it hasn't. So I would say, if you say, what's the impact of the war so far, is that the South oil prices have soared, but they haven't come down. There's a floor. Now the question is, off of that floor, does it stay there, or does something else happen that causes it to spike up to that $120, $150 barrel oil that some people have been talking about? But this is a potential war as much as anything, and the U.S. is losing. The Russian sanctions have failed. I teach a seminar in financial warfare at the U.S. Army War College, and I told my 2022 class, this is April 2022, not long after the Ukraine war started, I said these sanctions are going to fail, and worse than that, there'll be blowback that's going to hurt the United States more than it's hurt Russia. That's happened. So we know a lot. There's a lot we don't know. I think those are the things that are really going to tip the global economy into a global recession, if not a a financial crisis. Well, right, and I've been doing this for a long time. I mean, I was a facilitator and a participant in the Pentagon's first ever financial war game in 2009 at the Warfare Analysis Laboratory, part of Johns Hopkins. It's a top secret lab about halfway between Washington and Baltimore. The Pentagon did not need my help in war games, but they did need outside expertise in financial war. They had never done that before. And I even recruited, and they sort of, they had the FBI and the CIA and the Treasury and think tanks, what I call the usual suspects. I said, look, if you want a really good financial war, it involves, lying, cheating, and deception. We got to get some Wall Street people in here because that's what they're good at. So I was able to recruit a top private equity manager and one of the top analysts for one of the biggest banks in the world. So we got a little Wall Street expertise in the room. It went extremely well. By the way, the scenario we did in 2009 was that Russia and China were going to accumulate gold and start a new gold-backed currency and try to run the dollar off the road. So we did that years ago, warned the Pentagon. The whole idea of a war game is not to do today's war. It's to look 5-10 years down the road and help people prepare for what might be coming. We're there now. I mean, I talked about the BRICS and other multilateral efforts to get out from under the dollar. But I did another war game, what we call tabletop. You just get 11, 15 experts around the table, and you talk it through. It wasn't quite as elaborate in that sense as the 2009 war game. But I was sitting one seat away from one of the top officials at the United States Treasury. He was like the dollar guy, liaison to Asia, Japan, and China, and so forth. So I basically tell them the greatest threat to the dollar doesn't come from overseas. It comes from the United States itself. We're the ones destroying the dollar by overusing sanctions. And that's what I said at the time. I said sanctions can be effective, but when you overuse them, you create an incentive for your adversaries to get out from under the dollar system, to come up with alternatives. Easier said than done, takes a long time, but they begin working on that because they don't want to be the next victim. If you say, what was this, I hate to use cliches, but the straw that broke the camel's back is when the United States froze about $250 billion of treasury notes and securities owned by the Central Bank of Russia. Those were their reserves. They had them invested, not all of them, but a lot of the reserves in U.S. treasuries. We froze them. That was unprecedented. I mean, we kicked Iran out of SWIFT, and we did the same thing with Russia. We did a lot else to Russia, but freezing central bank reserves of a major global power, largest atomic nuclear arsenal in the world, et cetera, had never been done before. Well, think about that from the perspective of, Brazil, Saudi Arabia, India, Turkey, a lot of other countries. You're sitting there saying, well, if they did that to Russia, what if I do something the United States doesn't like? Are they going to freeze my reserves? And the answer is maybe yes. So you've now created a very powerful incentive to get out from under dollar hegemony. It didn't come from them, it came from us because we were overusing the reserves. So I pointed this out in this war game I'm describing. And this Treasury official, he kind of like slammed both hands, like face down on the table, like boom, like that. He goes, the dollar has been the global reserve currency. It is the global reserve currency today, and it will always be the global reserve currency. And I turned around and I said, I feel like I'm in Whitehall in 1913 listening to John Bull say sterling is the global reserve currency and it always will be. And then, 30 years later, it was done. But you can't get through. I mean, I always get the meetings. I mean, I've been in the Pentagon Office of Net Assessment, which is their futurist think tanks. I've been in the Treasury and the Fed, et cetera. The only people who kind of understand what I'm saying are the military and the Office of Secretary of Defense, because as I say to them, I say, when the rest of the government screws up, it ends up in your lap. Like the military, and that's going to happen in Israel, the military is going to have to come in and pick up the pieces that other people in the State Department, the Fed, and the Treasury have, scrambled. So they kind of get it, but the Treasury doesn't get it. The Fed's kind of not, they don't really do international stuff. It's not part of their mandate, so-called. The White House, Janet Yellen doesn't understand anything we're talking about right now. She's a statistics geek from Berkeley, probably a high IQ, no common sense, no real international experience, so she doesn't understand this. So when I taught my financial warfare seminar at the U.S. Army War College in 2022, as I mentioned, I told them it was all brand new. The sanctions was coming. I understood them. I worked with sanctions for decades. And I said, they're powerful. They're going to fail. They won't work for a country like Russia. Russia has too many alternatives. And the big factor was that nobody joined in. China has not joined the sanctions. India, Brazil, Turkey. These are large, powerful countries. None of them have joined the sanctions. So there's no coalition of the willing. It's like a non-coalition of the unwilling. When Russia has that many trading partners, who won't join the U.S. sanctions, they have a lot of alternatives. They have other places to sell oil, other ways to get currency payments, other ways to keep their economy afloat. We're losing the financial war to the BRICS. Not all at once. These things can take years to play out. But we're doing it to ourselves by abusing sanctions. They're weaponizing the dollar. Well, we weaponize the dollar. You should expect that trading partners are going to weaponize back. And that's what's happening.